Hi, I'm Susan Chavinsky with Morningstar. A new type of target date fund may be popping up as an option in your 401k plan, target date funds with annuities. Here with me to discuss how these new funds work and how investors can determine whether these funds are a good choice for their particular circumstances is Jason Kephart. Jason is Director of Multi-Asset Ratings with Morningstar and co-author of some new research called Target Dates and Annuities. It's complicated. Hi, Jason. Thanks for being here.
Thanks for having me, Susan.
So first, walk us through how these new target dates with annuities work.
So very similar to a normal target date fund. You'll invest in them hopefully early in your career, save what you can, keep your hands off it, don't make any sudden moves, let the target date do its work. But instead of just investing in stocks and bonds, what they'll do is start to allocate to an annuity contract earlier on, maybe 10 to 15 years from retirement. And that will give you the option to annuitize a portion of your portfolio at retirement. So if you want an annuity at if you know you want an annuity, these could be a good option for you.
So how can people invest in one? Are these strictly available through someone's 401k plan?
So right now they're only available through 401k plans. The products are being launched as collective investment trusts, which are not available outside of 401k plans yet. So it's really going to be up to your company and your plan sponsors to decide if this is an option for you or not.
So Jason, these target dates with annuities provide investors with guaranteed income in retirement, which is, could be really convenient for an investor who might struggle with going from the situation where he or she's receiving a paycheck versus having to pay themselves in retirement. It's a very different dynamic. But of course, there's some downsides to this, to these target dates with annuities. So let's go through a few of them. The first, you say, could be fees. How do fees compare for the standard target date fund versus a target date fund with an annuity?
Well, as the title of the paper says, it's complicated. So the tricky thing is there's two types of annuities that are common in these target dates. One is a standard income annuity where you give a lump sum and you get a regular monthly payments. Those annuities don't really have explicit costs on top of them. There's no extra basis points. It's more like your checking account. You know your checking account's not free, but the interest payment you get from your bank is not all the interest payment they're making off your money. Sure. So that makes it hard, I think, to compare one-to-one because of that opaqueness. The other ones that they are common are savings annuities, kind of like a fixed index annuity. These do have explicit costs, and they can be around like 1%. So in target dates where fee compression is like so strong, and we see a lot of let's call them opportunistic lawyers who are happy to file lawsuits over fees for 401k plans very fast, that I think creates a barrier to kind of adoption. And plan sponsors really have to make sure they understand these and understand that cost and benefit trade-off, so they can communicate that to investors who might be scared by seeing, well, why am I paying 1.1% for this when I could get Vanguard for 8 basis points?
Right. So then in real world terms, what are the implications over time for those additional fees that these guaranteed income versions would offer?
Yes, I think in the scenario with the savings annuities where you can actually see the fee, I think the risk is you're paying this fee without actually using the benefit. Like perhaps you roll out of your 401k and you switch from a target date that has a savings annuity into it to IRA where that's not an option. Well, you were paying that 1% fee, and now you're not really getting that kind of insurance from it. So I think that's kind of a potential drawback. So I think if you're going to invest in these, you really have to commit to really get the full benefit from them.
Got it. Now, a second issue to be aware of when investing in a target date with an annuity is understanding which type of annuity the target date fund is offering, whether it's an income annuity or a savings annuity. So let's unpack the differences between those two types, starting with target date funds with an income annuity. How do they work?
So these are your kind of standard annuities where, say, you hit retirement, 30% of your portfolio gets carved out. That money gets given to an insurance company. In exchange, you get a contract for a guaranteed set of payments a month. So that might be some peace of mind for a lot of people, but those payments are going to be fixed generally. So even benign inflation, not like what we've been seeing with like cocoa prices, but even benign inflation is going to eat away at that over time. So that's kind of a risk. But the benefit is with the rest of your portfolio, because you have that kind of guarantee, you can invest a little bit more aggressively and take a little more risk and maybe offset some of that. So that's why, just doing a portion of your portfolio really makes sense. So that's kind of how the income annuity works in general. I think that's the more straightforward of the two.
All right, well then let's get into the more complicated one, Jason. Let's talk about how the target dates with savings annuities work.
Yeah, so savings annuity is kind of this catch-all for everything that's a little bit more complicated in the annuity world. Fixed index annuities, variable annuities, and the common thing that they all have is these guaranteed lifetime withdrawal benefits. So this is really the benefit that the person's going to receive based on kind of the high watermark of your account. So that's the nice thing. Even if your high watermark's at age 63, not 65, the guaranteed withdrawals will be set at that 63 a start. And so they'll say, like, we guarantee you a 5% withdrawal rate a year. So if you do that, even if you run out of money, then the insurance company will start paying the 5%. So you actually have more control over your balance. The trade-off is you can take more than that, say, 5% out. You say, oh, I want to go on vacation this year, or, I want to go see this pickleball tournament. So, you take out, 10%. But then what the insurance company's probably going to do is say, okay, well, going forward, that 5 is now 4. Yeah. And so it kind of ratchets down. So that's kind of a trade-off. And that's the one where you also have that 1% fee on top too. So if you're paying that 1% fee and you never actually run out of money, then that 1% fee was, I guess that's how insurance works too. Sure. Like, it's better to pay fire insurance and never have to use it. Right. So I think that's how the savings annuities work. But I think that one's a little bit more complex because the annuities, like fixed index annuities, they do have some upside potential. So you can outpace inflation. So that's a benefit, but they're much harder to understand. They're not very straightforward.
Got it. So does Morningstar think in general that one type is better than another?
I think it depends on the person. I think income annuities are a little bit easier to understand. And when we look at kind of the trend in product launches, the more recent trend is ones launching with income annuities. And I think that might be because they are easier to explain. I think when you're a plan sponsor at a 401k plan, being able to communicate effectively with your participants, the easier that is, the more they're going to use it and the more that actually it works. And I think the real question is, 5-10 years from now, even if these things work perfectly as described, if people aren't participating and opting in, then there's no reason to use it over a traditional target date fund.
Got it. So the third issue to consider before investing in a target date fund with an annuity is recognizing that these really aren't one-size-fit-all retirement income solutions. Explain that.
Yeah, I mean, everyone's circumstances in retirement are going to be different. Everyone's risk tolerance is going to be different. The more risk averse you are, probably the more that having that kind of guaranteed income in your back pocket is probably going to help you sleep a little better at night. But for some people, they might not think that is really a benefit. And, the amount to annuitize, some of these are fixed in these target date funds. Some let you choose your own adventure, so to say. So finding out what the right amount to annuitize for you too, that's the other hard part. And I think that's all going to be a personal preference thing. That really comes down to like risk tolerance and their own circumstances. I think the other thing that's hard with these target date funds is they really rely on what you have saved in your 401k in that target date fund. So you have assets outside of that. I think each individual has to take that into account too.
Yeah. Well, thanks for your time today, Jason. I mean, I guess it's good that now investors are going to have perhaps have another option to choose from, and choice is always good, right? So thanks for your time.
Thank you.
I'm Susan Javinsky with Morningstar. Thanks for tuning in.